Hi folks, and welcome to Exams Made Easy. This video is the sole trader final account for the 2017 paper. It's 120 marks out of 400, so it's worth 30% of the whole paper. If you can do this question, you're off to a great start in your exam. How I'm going to approach today's video, I am going to go through the question, and then there are 10 instructions which we have to do, 10 notes, and I'm going to show you the marking scheme at the end where everything goes. So I'm going to go through the notes in a fair bit of detail to make sure you're able to do each one of the notes. So don't be afraid to pause this video at any point, rewind or fast forward to make sure you have the notes very clear. As you will see through the years, some of the notes come up again and again and again. So for example, the depreciation note, you really need to practice and practice and practice this. Okay, so without further ado, we will carry on and we'll go through the question. So I have the question on the screen. That's what it looks like. Sole trader of M. Mullen, trial balance extracted from the books of M. Mullen on the 31st of the 12th, 2016. And then we are given the trial balance. After the trial balance, in this case, we are given 10 notes, which we are going to have to do. From 1 to 10, I'm going to go through them in order. And we are asked to prepare a trading profit and loss account for the year ended 31st of the 12th, 2016. This is worth 75 marks. And then a balance sheet for the same year, which is worth 45 marks. So 75 and 45. Huge marks available for this question. So the notes are crucial, and you need to do a detailed set of notes so that if you transfer a number incorrectly, for example, into the accounts, it may be worth 8 marks. If you have no notes and you write down the number wrong, you get 0 out of 8. But if the corrector can look back in the notes and see that you actually have it correct in the notes, you may get 6 out of 8 or something like that. So notes are crucial. So I'm going to go ahead, I'm going to go through each note in detail and explain where the figures are coming from. So note number 1. Stock on the 31st of the 12th at cost 75,000. This figure includes damaged stock which cost 4,500 and now has a net realizable value of 3,000. So as you see along the bottom here, I have them labelled workings 1 to 11. So working number 1 is closing stock. And what has happened here is part of the stock has lost value. The stock has lost €1,500 of value, which is the difference between 4,500 and 3,000. Therefore, 76,500 minus 1,500 equals 75,000 is your figure. And that figure is going to go in the trading account. So we'll just call that P, and it's also a current asset in the balance sheet. I'm going to put that in red just to make it stand out. So that's where that figure is going to go. Now, as we go through the question, there may be times where that number may change, but at the moment, the 75,000, so I'll also circle it, 75,000 is your trading figure and your current asset figure. So that's a straightforward note to start. Note number 2, provide, and this is a very common note, it's your depreciation and your disposal note. So what we are looking for in this is 5 things, which will always be. We are looking for, so I'll just read the note first. Provide for depreciation on delivery vans at the annual rate of 15% of cost from date of purchase to date of sale. Note on 31st of the 3rd, 2016, a delivery van which cost 40,000 on 30th of the 9th, 2012 was traded in against a new van that cost 48. An allowance of 18,000 was given on the old van. The cheque for the net amount was entered in the bank account but was incorrectly treated as a purchase of trading stock. These were the only entries made in the book in respect of this transaction. So I have the accounts here. The accounts we are going to use are delivery vans, depreciation, disposal, and the last bit says that the net amount of the transaction was incorrectly treated as a purchase of trading stock, so that's going to be purchases. Okay, so like I said up here, you're looking for 5 things. So you're looking for a new delivery vehicles figure, you're looking for a P&L depreciation figure, you're looking for an accumulated depreciation figure, you're looking for a profit or loss on disposal, and most of the time it's a loss, and you're looking for a new purchases figure. So there are a lot of marks going for this note, probably around 15 or 20 marks. So I'm going to take you through it. It's going to take a few minutes and I'll explain where every number comes from. So first of all, we start with the opening balances of what we know. So first of all, if we go to the question, the trial balance, I am looking for, up here, we have delivery vans that cost 150,000 and trial balance figure 85,000. So that tells me cost 150, I'm going to put that in. Depreciation is the difference between these two numbers, which is 65,000 depreciation. So when I go back here, my opening balance for delivery vans is 150,000. My opening balance for depreciation is 65,000. I also have an opening balance for purchases. If you look at the trial balance, that opening balance is 536,500. Okay, so those are the opening balances we have. So this note always follows the same way. So we'll start with the delivery van which was disposed of, cost 40,000. So delivery van's disposal, we credit 40,000 in the delivery van's account and we debit it in the disposal account. Okay, so that was the old van gone. The new van cost 48,000 and an allowance of 18,000 was given on the old van. So in the delivery vans, we're going to put allowance 18,000, that's like a trade-in, and we're going to credit that in the disposal account, 18,000. Now it says the check for the net amount of the transaction. So the new van cost 48, we were given an allowance of 18, so the amount that actually came out of the bank was 30,000. So we debit delivery vans 30,000, we credit purchases 30,000. That's how much was actually paid for the new van. Okay, so we have some figures. The next figure we're going to work out takes a bit of calculation. We are going to, when you dispose of a van, you must dispose of the depreciation as well. So we are looking at some dates here. The van was bought on the 30th of the 9th, 2012, and it was traded in on the 31st of the 3rd, 2016. So what I'm going to do at the side here, how many months is that? So in 2012, that was October, November, December, 3 months. Then we had the whole of 2013, I'll just put 13, 14 and 15. So that would be 36 months, 3 years. And then in 2016, again, we had 3 months because we disposed of the van on the 31st of March. So in total, 42 months worth of depreciation. So the calculation would be 40,000 at 15%, divided by 12 multiplied by 42. And that would give us an answer of 21,000. So 21,000 would be your answer. Where does that go? That is your disposal depreciation of 21,000. So we debit depreciation, we credit the disposal account, 21,000. Okay, so that's the information for that. So now we have that information for the disposal depreciation. We can go ahead and we can balance off some of these key accounts and get some figures. So first of all, I'm going to deal with the disposal account. If you add up both sides, you have 40,000 on this side, you have less on this side, you have 39,000 on this side. So we are going to have here a loss of 1,000 in this account. So there is a loss on disposal, because if you think about it, the delivery van was 40,000, take away depreciation of 21, which means it was worth 19, but you only got a trade-in of 18. So therefore there's a loss of 1,000. So I'm just going to circle that. Loss of 1,000, and it's in red. And that is going to go as a expense. That would be a selling and distribution expense in the P&L. Okay, so that's one figure. I'll just swap here. That's one figure done. Second figure I'm going to do is the purchases account. So again, we can balance it off and do all that. So I'll do it very quickly. 536, 500. 536, 500. So the balance would be, in this case, 506, 500. 506, 500. So it's brought down here. Balance 506, 500. So again, where will that go? That will go in the, I'm going to circle it, that would go in the trading account. That's our second figure, so purchases figure. Third figure we're able to work out now is the new delivery vans figure. So delivery vans, if we balance this off, add up both sides, we get 198 is the big side. So 198. The balance, therefore, is 158. So the balance of 158000. And that will be, I'll just circle it here, that figure there, the 158, is a fixed asset and actual figure for delivery vans. Okay, what we're looking for here now in the depreciation is your depreciation for the year and then your balance of depreciation, which will be your accumulated depreciation. So if we look at the delivery van account, at the beginning of the year, we had 150,000 worth of delivery vans for 3 months, because after we disposed of the van, you can see up here, our vans were then worth 158,000 delivery vehicles. So for the first 3 months, it would be 150,000 at 15% times 3 over 12, because it was for 3 months. What that would give us is 565. For the remainder of the year, we had 158,000 at 15% times 9 over 12, which would give us 23,400, giving you a total, giving you 17,775, giving you a total of 23,400. That's the figure we are looking for, 23,400. it goes up here, 23,400. Now, by balancing this account, we will find out what the accumulated depreciation is for the year, which is 67,400. Goes down here, 67,400. So here's my final two figures that I'm looking for. So the 23,400 is my S&D expense, and my 67,400 goes into my fixed assets. That is accumulated depreciation. And when we look at the marking scheme, we'll see. So we have our 5 figures right there. Okay, lots of marks there. So go ahead, rewatch this if need be. Make sure you can do that note and practice it out. It very rarely changes. Okay, note number 3. Note number 3 is a suspense figure. Suspense figure arises as a result of the incorrect figure for mortgage interest, although the correct figure had been entered in the bank account, and a VAT refund of 2,000 entered only in the bank account. Here, 3 accounts here: mortgage, interest. I'm going to look back at the question and see where does it mention suspense. You can see down here, insurance is the account that we're going to deal with because it incorporates suspense. So I'm going to change my insurance account. And the third one, a VAT refund entered only in the bank account. So wasn't entered into the VAT account. So we're going to have to fix that. So we're going to take 3 figures from the trial balance. So if I look at the trial balance, I see mortgage interest paid for the first 3 months, 2,400 on the debit side. Insurance, 17,700 on the debit side, and VAT, 6,400 on the debit side. So these are my opening balances. 2,400. Insurance balance is 17,700, and VAT balance is 6,400. So the first thing I need to work out is what is the correct figure for mortgage interest. So I go back to the trial balance. Mortgage interest, if we look here, we have a 6% fixed mortgage of 180,000. And mortgage interest was paid for the first 3 months. So when we work that out, we have mortgage interest. So mortgage interest is 6% of 180,000, which equals 10,800. Okay, that's for the year, the figure for the year. Then we must take away 3 months. 3 months. Okay, whatever way you want to do that. So you could do 180,000 at 6% divided by 12 multiplied by 3 gives you 2,700. Take one from the other and you get 8,100. Okay, 8,100 is due. So what we have here, a couple of figures. We have 10,800. That is our mortgage interest in the P&L. The 8,100 is mortgage interest due, which is a current liability. Okay, so I'm just going to change color to highlight these. So that one should be red. Okay, we'll leave it circled. Okay, so we can see here our mortgage interest, one figure for the P&L, 10,800. Mortgage interest due 8,100. These are the two figures. Now, as you can see, we worked out 3 months interest, and 3 months interest should be 2,700. But when we look at the mortgage interest account, it's down as 2,400. So there's a mistake here. In order to get that to 2,400, we have to debit €300. We must do a double entry. So the insurance is our suspense. So I'll just add that in. Okay, so we've debited 300, so we must credit 300 here. That's the first part of the question. And the second part, a VAT refund of 2,000 entered only in the bank account. So a VAT refund, we would have debited the bank account, so we must credit the VAT account. Again, in this case, we've credited the VAT account, so we debit the suspense account 2,000. Okay, so now we balance these accounts to get our figures. Now the mortgage interest account, I'm not bothered. I've done what I need to do there, so I don't need to do anything with that. These are my figures over here, the 10,800 and the 8,100. That's all I need. The insurance, however, if I balance this account, okay, so I'm going to balance this account. I would get 19,700. I need 19,700 on this side. My balance is 19,400, which comes down on the debit side here. That is now my figure. So I will circle it. That is my figure for insurance, and that would be an admin expense. My VAT figure, 6,400 on this side, 2,000 on this side. So again, if I balance this out, I get a balance of 4,400 on the debit side, brought down. That's the figure I'm looking for. And that will be, it's VAT on the debit side, which means it's a current asset in the balance sheet. Current asset because it's on the debit side. If it was on the credit side, it would be a current liability. Okay, so 4 figures. Mortgage interest for the year, 10,800. Mortgage interest due, 8,100. Insurance figure, 19,700. VAT figure, current asset, 4,400. Working number 4, patents, a very common working. Patents incorporates 4-month investment income is to be written off over a 5-year period commencing in 2006. The first thing we need to work out is investment income. So if I look back at the trial balance, I'm looking for investment income. So here, 3% investments from the 1st of May 2016. So we invested the money on the 1st of May. So that would mean we have 8 months investment income for the year, and 4 months have been incorporated in patents. So 8 months is what I'm going to work out first of all. So investment income, 3% of 200,000 times 8 divided by 12, which would give you €4,000, and that would be called investment income in the appropriation account of the P&L. Okay, so that is one figure that we are interested in. Now, that's 8 months. So we were told that patents incorporate 4 months. So quite simple maths there. You're going to take away, so less 4 months. You shouldn't need a calculator. 4 months would be half of that, which would be 2,000, which would mean investment income due of 2,000, which will be a current asset, investment income due. The two figures, 4,000 is the figure in the P&L for investment income. It's another income. And investment income due is a current asset of 2,000. Now we deal with the patents. If we take the patent figure from trial balance, patents figure is 68,000 on the debit side. So opening balance 68,000. The 2,000 that we just worked out for investment income, we debit that 2,000. Okay, so we have in total 70,000 is what our patents are worth. We are told patents are written off over 5 years. Therefore, 70,000 divided by 5 equals 14,000 is your patent written off. 14,000 goes here. We'll call it written off. Your balance is 56,000, which will go down here, and that will be your intangible asset figure. So the 14,000 will be an expense in the P&L, will be an S&D expense, and the 56,000 will be an intangible asset in the balance sheet. That is note number 4. Note number 5, provision to be made for both investment income due and mortgage interest due. If we go back, note 3, investment income due, there it is, 8,100. Note 4, mortgage interest due, sorry, note 3 was mortgage interest due, 8,100. Note 4 was investment income due, 2,000. So that note has already been done, nothing to do there. Next note, note number 6. A creditor who owed 7,600 accepted office equipment with a book value of 6,500 in full settlement of a debt. The office equipment had cost 11,000. No entry was made in the books in respect of this. Provide for depreciation of the office equipment held at the end of the year at 20% of cost. Okay, a couple of things here. We are looking at equipment. We are looking at depreciation. We have a creditor, because a creditor who was owed 7,600 accepted equipment which was worth less. So because the equipment was worth less, that creditor obviously gave us a discount, so we have a discount account as well. So let's go through. So we will deal with the equipment account first. So I'm just going to find the equipment up here. So office equipment cost 25,000. Net book value 15,000. So as you can see, there was obviously depreciation there of accumulated depreciation of 10,000. So when we put in our opening balances, opening balance of equipment 25,000, opening balance of depreciation 10,000. I'll also put in opening balance of creditors, which is 78,000, and discount 3,200 on the credit side. So creditors balance 78,000, discount balance 3,200. Okay, so those are our opening balances. So let's see what happened. A creditor who was owed 7,600 accepted off his equipment with a book value of 6,500, but it cost 11,000. So it's 11,000 which will credit equipment. 11,000 equipment is credited. Okay. Now depreciation, we just can work it out. We don't need to do any calculation. Basically, the equipment had cost 11,000 and had a book value of 6.5. Therefore, the depreciation was 4,500. Okay. From that, the creditors, we owed the creditors 7,600. We will reduce creditors by 7,600. We owed the creditor 7,600, but they accepted 6,500, so they have given us a discount of 1,100. The difference between 7.6 and 6.5. So that is what's happened. So now, if we balance these accounts, we will get first of all, we'll balance the equipment account so we can work out the depreciation for this year and get this year's depreciation. Okay, so the equipment account balances at 14,000. 14,000 will be our fixed asset figure for equipment. So from that figure now, that's the figure at the end of the year. We can work out depreciation for the year. So 14,000 times 20%, which gives us 2,800. That's our P&L figure in depreciation. And that is a expense. In this case, it would be an admin expense. Okay, from here we can balance again. So 2,800. Balance will be 8,300 down here. Brought down 8,300, which is your accumulated depreciation in the balance sheet. So I'm just going to circle that. That's your admin expense called depreciation of equipment. That's your accumulated depreciation. So you're going to have equipment 14,000, accumulated depreciation 8,300. Other accounts that we need to just balance to get the right figures. So our creditors account, I'm just going to do this shorthand. So 78,000 minus 76, basically 70,400 would be your current liability. Discount, both on one side, so I'm going to do it short again. 4,300 is your discount, and that is a gain because that's discount received. So in the P&L, that's going to be a gain, which I will show you in the solution. Okay, so 5 figures, sorry. Working number 7. Provide for depreciation on buildings at the rate of 2% of cost per annum, and the buildings are revalued at 800,000 at the end of the year. So we're going to have a buildings account, we're going to have a depreciation account, and we're going to have a revaluation account. So again, go back to the trial balance. Buildings cost 680, net book value 595. When you do the maths, that's 85,000 depreciation. So go back here and put in the opening balances. Opening balance 680,000. Opening balance 85,000. Okay. So buildings revalued at 800,000. What does that mean? Reval To get 800,000 from 680, you must add on 120,000. So debit buildings, credit revaluation, 120,000. Okay, so basically your buildings is now 800,000. Let's add an extra zero there. Okay, that is your fixed asset buildings. There's going to be no depreciation in the balance sheet. It's just going to be 800,000, no depreciation, 800,000 when I show you. So what happens when we do a revaluation, we get rid of the depreciation. So we must, because it was done at the end of the year, we must have this year's depreciation put in. So the P&L depreciation, I'm going to do it down here, would be, let's see, it would be 680,000 times 2%, which equals 13,600. 13,600. That would total, let's see, okay, we'll do it this way. Total 98,600 would be your balance there. Okay, that 13,600, that is a admin expense. Admin expense in your P&L. Now, with the revaluation, what we must do, I'm just going to take the total here of all the depreciation, 98,600. I'm going to call it here, I'm going to call it reval 98,600. So the depreciation account balance would be 0. And over here, depreciation 98,600, which gives our depreciation, sorry, our revaluation reserve 218,600. That goes in the finance by section of the balance sheet. 218,600. Okay. Working number 8. A cheque for 700 had been received on the 31st of the 12th in respect of a debt of 1,200, previously written off as bad. The debtor wishes to continue trading and has undertaken to pay the remainder within 1 month. No entry was made in the books in respect of this. Okay, so 3 accounts going to be dealt with here. Debtors, someone who owes you money. The bank, because we've got a cheque and we have recovered the bad debt. So bad debt covered. If I take the debtors figure from the trial balance, it is, let's see, debtors and creditors, 70,500 here. So opening balance, 70,500. Our bank figure is 70,300 on the credit side. $70,300, and bad debt recovered is a new account. So what happened? A cheque for 700 had been received into the bank. So bank debit 700 for a debt of 1,200. So we're still owed 500. So we're going to debit debtors 500, and our bad debt recovered is going to be credit 1,200. So when we balance these, so I'm just going to add this up, 71,000 will be our debtors figure, which I'll circle, which will be a current asset. I'll circle that there. That is your debtor figure. Your bank figure, when you balance your bank, so 70,300, your balance is going to be 69,600. It's going to be down on the credit side, 69,600. Know that figure there. Okay, it's this figure here, the 69,600 is what I'm interested in. that is your bank figure, and it's a current liability because it's on the credit side. It's a bank overdraft, 69,600. Your bad debt recovered of 1,200 is a gain or an other income in your P&L. Okay, nearly there now, 2 more to go. So working number 9. No record had been made in the books for goods in transit. The invoice for these goods had been received showing the recommended retail selling price of 16,000, which is cost plus 25%. So first of all, we have to work out what cost price was. So selling price is 16,000, which is 125%. We need to work out 100%. So cost price is 100%, which is 16,000 divided by 125 multiplied by 100, which equals 12,800. Now we have that figure, the cost price. We are going to deal with purchases, creditors, and closing stock. Now, you need to be very careful here because we're not going to the trial balance because we have these figures in previous notes. Purchases, creditors, and closing stock. Note number 1, closing stock, 75,000. Okay, so we're going to go back to note number 1 and we'll score out 75,000 because we're not going to use that anymore. Closing stock, opening balance, 75,000. Purchases, I believe that was note 2. It was here, 506,500. You have to be very precise with these kind of things. You remember the notes. So 506,500 is your balance. Creditors, I'm sure we had a note dealing with creditors as well. Note 3, no, note 4, note 5, note 6. Note 6, 70,400 was our creditors figure that we changed. 70,400 creditors. 70,400. That was your balance. I won't make that red so we don't get confused. Okay, so now we can deal with it. So what we do, we are taking the cost price for all three. We are debiting purchases, 12,800. We are crediting creditors, 12,800. And we are debiting closing stock, 12,800. So in other words, you are adding to everything. You're adding 12,800 purchases, you're adding 12,800 creditors, you're adding 12,800 to closing stock. So we get 519,300. That's a trading figure. We get 83,200. That's a current liability. And we get 87,800 trading and current asset. Okay, quite a few numbers there. If I circle them, there's your trading figure. There's your current liability figure. There is your trading and your current asset for closing stock. Common enough note. Last note we're going to do, goods taken by Mullen for their own use, for his own use, were not recorded. These goods had a retail value of 4,800, which is cost plus 20%. Taken for your own use, that is drawings. Okay, and taken for use during the year, the goods had a retail value, which is cost plus 20%. That is dealing with purchases. We take it out of purchases. So the drawings figure from the trial balance is 15,600. 15,600. The purchases figure, remember we just did that in the last note, 519,300, so we're going to change that again. What that tells you is the purchases figure is going to be worth a lot of marks when we look at the marking scheme. 519,300 is your balance for purchases. So again, we must work out what the retail value, so the RRP was 4,800, which was 120%. 100% works out at €4,000. So again, what we do here, we're going to debit drawings and we're going to credit purchases this time. We debit drawings 4,000, we credit purchases 4,000. Okay, we debit purchases. So our new drawings figure will be 19,600. Okay, I'm going to make that red. And that goes in the finance by section. Our new purchases figure, when we balance this off, we'll balance it. The balance will be 1,300 on the debit side, and that is going to be your trading figure for purchases. I'll put that in red. Okay, so you have drawings figure finance by 19,600, purchases figure trading account 515,300. And that's it for the notes. Okay, we have 10 notes. That was a lot of notes. If we quickly look at the marking scheme, okay, I'm going to look down at the marking scheme, which is available. I'm taking mine from educate.ie, but it's available in numerous places. All of the notes we have dealt with are here. So the trading profit and loss account worth 1 mark. So I'm just going to tick things as we go along. 1 mark per heading. Sales figure doesn't change, 2 marks, that's straight from the trial balance. Opening stock, 2 marks, straight from the trial balance. As you can see here, purchases figure is worth a huge 10 marks, 515,300. If we look at our last note, 515,300. Closing stock, 87,800. The previous note, 87,800, right there. Huge marks, 10 marks for that, 7 marks for that. So the notes are extremely important, and make sure you write them out fully. Then we go down to the admin expenses and the selling and distribution. Make sure you have them separated, because there will be a mark going for the headings, or a mark lost if you don't put in the headings. We have patent written off, we did that. Salaries and general expenses. I believe that hasn't changed, has it? No, that hasn't changed. Rent hasn't changed. Insurance, we had a note, the suspense note. Depreciation of office equipment and depreciation of buildings, we had notes. Loss and sale of van, we had a note. Depreciation of delivery van, we had a note. Commission did not change from the trial balance. Here was our gains or our other income, bad debt recovered, and discount, including profit on the sale. So that was discount. We had a note on that. We have investment income, we have a note on that, and we have mortgage interest, a note on that. As you can see, the final answer gets you 6 marks, 50,600. But all of these notes we have. Balance sheet, we did a patent note, intangible asset, 56,000. We revalued the building, so 800,000, no depreciation, 800,000. Office equipment, we did a note, a couple of notes, 14,000 cost, accumulated depreciation we have in our notes. Delivery vans, same thing, we did a note. Investments, straight from the trial balance. If we look at the current assets and creditors, stock was our closing stock figure. We had a note on that. Debtors minus provision. The provision comes straight from the question. We didn't have to change that provision. Debtors, we did a note. Investment income due, there was a note. And VAT, there was a note. Creditors, you can see worth 6 marks. So there's a couple of notes on creditors. Bank is an overdraft, so just be aware that our bank account, whichever note it was it 6, 5, 7, 8? Note 8 is on the credit side, so it's a bank overdraft, which is a current liability or a creditor falling within 1 year. Be careful with that. PAYE, that doesn't change. Mortgage interest due, we had a note. So there's your figure, the 1,131,500. Mortgage figure comes from the trial balance. Capital figure comes from the trial balance. Revaluation reserve we worked out using a note, and the drawings figure, as the net profit comes from above, less the drawings figure we did on a note, you should get it to balance. There are a lot of figures there for your notes. Take your time, go through the video again, but practice this question. As I say, with all questions in accounting, don't practice until you get it right, practice until you cannot get it wrong. Thanks very much for watching. I hope this helps.